Welcome to another video in the Futures Insights tutorial series. In this episode, we dive into the world of dry powder indicators, an essential tool for your market analysis. But before we begin, here's a quick overview. Futures Insights is your all-in-one solution for the fundamental analysis of future markets. The software automatically analyzes CoT data, seasonal patterns, open interest, and term structures, making trading opportunities instantly visible. With 7 unique sentiment indicators, it covers 25 of the most important futures markets and helps you execute trades confidently with maximum success rates. In this video, we'll show you, using the gold market as an example, how to properly interpret the dry powder indicators and integrate them into your decision-making process. Stay tuned, it's worth it. The first indicators that we'll look at together are the CoT indicators. They use a sophisticated algorithm to evaluate the positioning of commercial traders and large speculators. We use 2 different sets of indicators for the commercials and non-commercials: the dry powder view and the OBOS graph. Let's start with the dry powder indicators, as they are much easier to understand. We do the whole thing using the example of managed money in the gold market. As you can see, we have an x-axis and a y-axis and lots of colored dots scattered across the graph. On the left, we see the long positions of managed money, and on the right, the short positions. They look at positioning in 2 ways. The first is open interest. It provides information on how many contracts the large speculators are currently long or short with. We see the open interest in both graphs on the y-axis. The x-axis, on the other hand, shows us the number of trading institutions that are currently holding these long or short contracts. The larger white dot shows us the current positioning. In this case, the managed money holds a total of 95,850 long contracts. These 950,850 long contracts are held by a total of 74 different trading institutions that are classified as managed money according to the disaggregated CoT report. The smaller green dots, or in the short graph, the smaller red dots, show us the historical values. The brighter a point is, the closer the value is to the current dates. Very faint points are far in the past. So we can now use this cloud of points to see how much the open interest has increased or decreased at most or at least over the last 7 years, and how many trading institutions have held these positions at most or at least. Of course, very interesting statements can be made about this. Imagine you want to open a short position in gold in the near future, but you're afraid that the price could rise even further. But now you can see that the current value in the dry powder indicator is at the top right. For example, 120 trading institutions have a long position and hold an open interest of around 290,000 contracts. So almost all trading institutions that have held long positions in the gold market in the last 7 years are already long, and they are already positioned close to the historical maximum in this period. Who should keep buying when everyone is already long? Of course, this statement should always be treated with caution. Historical maximum values can always be expanded, and the managed money are not the only market participants. Nevertheless, we definitely see a high probability in this example that there is not much upside potential left. On the other hand, once the price actually starts to go down, all the speculators with their long positions will have to close them sooner or later. Then what do? Of course, they sell. These sales in turn are now also driving our short rate. We can of course interpret it the other way around with the commercials. As you can see, historically few institutions classified as producers, merchants, processors, or users hold a short position. In addition, the short open interest is at an extremely low value. So the commercial traders have little interest in selling their goods at the current prices. This tells us that they most likely think the current prices are too low. So we can conclude that they expect to see higher prices again soon and then use them to sell their goods. The dry powder indicators are independent of the dashboard and do not transmit any values to it. They are used for a deep analysis of the respective market. In the following two videos, we now deal with the OBOS framework.